All right, what is up, everyone? Very excited to bring you today's video. The Fed rate cut is coming very soon. All right, we're going to discuss that, go over some charts as well. We'll talk about the historical Fed hiking cycles. We'll talk about the historical Fed policy changes, what our current situation is to the past. And we also are in one of the longest phases ever between a Fed rate increase and the first cut. We'll break down what happens to the first rate cuts historically in the market and as well as the technology sector. And then we'll talk about what happens after the fall and go over the complete history of Fed cuts and how the magnitude of the drawdown is really dependent on a recession versus a non-recession. And then we'll talk about some of the things that could cause a recession, right? We've got the yield curve, obviously is one that everyone is talking about. We'll talk about the GDP based recession indicator index. All right, we'll go over the SOM rule. We'll talk about jobless claims and the labor market, inflation adjusted credit card debt. We'll also go over the win rate by a holding period. We'll take a look at the advanced decline line. This is the number of stocks advancing versus declining. And we see we're making new all-time highs again here after this week, which is one of the reasons it's been a little hard for me to short the market. We talked about the equal weight versus market cap weighted S&P 500. We'll break this down and go over how we just saw new all-time highs in the equal weight S&P 500 not too long ago, and how we're quickly approaching those levels here again. And of course, we'll break down TLT and go over a few of my favorite TLT charts. All right, this is a pretty basic one. We'll go over the three important lines here, what those are, why those are so important, and what really led to a lot of success in our trading of TLT. Using those, we'll go over the Elliott wave analysis, what my price targets are around the Fed rate cut. And then we'll also go over the concerns, okay? There's always going to be risks when it comes to investing. And so you guys need to know some of the risks. This chart right here is going to explain some of the risks in trying to go long bonds or long TLT specifically. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys. It's called Investment Intelligence. I give out free, valuable finance and trading related content, and I also try to sprinkle in some free trade ideas in there. So there is a website associated with it. You can go back and read some of the previous articles, see if it's something that you'd like to sign up for and get sent directly to your inbox. Now, I am doing a promo code Powell for the Investment Intelligence Private Trading Group. Okay, that will get you, a nice discount on the private trading group. And inside of there, you get 20 plus swing trade ideas every week, custom scripts and indicator, exclusive intel, exclusive chart layouts. As you can see, we've been launching a lot of new products, having some really great trade ideas inside of there. One of them is the Pulse Radar. Okay, so the Pulse Radar, there's Pulse Radar longs, there's Pulse Radar shorts. What it is it's a scan and an indicator setup. So you can get these for yourself along with the list of my technical analysis. The Pulse Radar is spitting out 1,000% trades, right? Literally PCG. You can see here on August 11th, posted the trade idea once this one popped up with the buy signal in the Pulse Radar longs. We had a nice inverse head and shoulders pattern, and look at the chart. Well, what happened afterwards, it absolutely just went ballistic. Call options, whether they were for the next year or the monthlies, they performed very, very well. Okay, that's the Pulse Radar. Those are designed to be a little bit of a longer term swing trade. Okay, so we've got the Zone Finder, which is intraday to swing trade. So these can work as a day trade, or if you want to swing them for a day, a couple days, maybe a week. Depending on your own risk tolerance and profit goals, you can hop in the Zone Finder or the Pulse Radar. Typically, you can swing trade them 1 to 3 days, or some of these can run for 30 to 45 days. Okay, so different time frames for different type of traders. If you're looking for quick trades, you can hop in the Zone Finder. The very first trade idea from the Zone Finder was published in the newsletter for free. It was a really nice trade on Bristol Myers, and that one went up over 275% on the call options. Just yesterday, okay, we put out in the Zone Finder the setup on BBY, which is Best Buy. And as I mentioned, the zone finder is meant for very short-term trades. And in one single day, the call options went up over 100%. So those doubled. Now we're just sitting on runners, and the rest of the trade is risk-free, right? Because we've already doubled our money. So even if we were to lose everything that was still in there, it's not really a loss. Okay, this is what the Best Buy chart looks like at the time of the screenshot of the recording. We talked about the 1-2 setup, right? We had the 1 up, 2 down. We're looking for a wave 3 up. If we could hold these support levels right here, and sure enough, we did. And got some nice juicy gains early this morning. Now, let's get into the video and talk about the historical Fed hiking cycles. As you can see, our current one is the fat line right here in light blue, sky blue. This is the most aggressive Fed funds rate hiking cycle, okay? Meaning that the rate of change, right, and the cumulative change in the Fed funds rate, this has been the greatest one that we've seen in history. Now, if you notice, is also very quick, okay? We have other cycles that last much longer, Fed rate hiking cycles. These are the number of months between the first, Fed rate hike. And you can see that this one is the third longest, all right? Now, when you look at the historical Fed policy changes, you can also see in red here, we have the hikes, okay? And in green, we have the cuts. And you can see how aggressive, just how aggressive this hiking cycle really has been. This is another really good way to visualize it. Over here, we had slow and steady, right? Just steadily raising by the same time every single time they did a rate hike. Over here, it was kind of sporadic, where we're doing hikes, then we're doing cuts, then we're doing hikes, then we're doing really aggressive hikes, and then we're doing really aggressive cuts. Here, we went through an aggressive period of hikes, and then we started to steady out. What's really interesting to me is that when you look at the months between the last Fed rate increase and the first cut, this is the second longest period that we've ever been in right here. And that's got a lot of people worried about what's going to happen when we get this first Fed rate cut. So on top, we've got the S&P 500. The red and green lines symbolize what happened to the stock market essentially afterwards, after the Fed rate hike cycle. And you can see 3 of the last first rate cuts ended up leading to lower markets. Now, one thing that I want to point out is that all of these were surrounded by a crisis, okay? Some type of, not just a normal recession or anything, right? We had the dot-com bubble, okay? This is the dot-com bubble Fed rate cut. Over here, great financial crisis Fed rate cut. These are very... and then obviously we ended up having the pandemic, okay? So the last 3 were some really historical events, okay? And I just want to point that out. So before then, if you look, the Fed rate cut cycle starting did not lead to negative returns in the stock market, right? So the last 3 did, but the 4 before that did not, right? And that's something you have to keep in mind, right? It's nothing is guaranteed. A lot of people are going to tell you just because we're getting Fed rate cuts that the market is going to crash. That could be true, but it's not a guarantee, okay? And in my opinion, you really have to ask yourself the question, are we potentially on the verge of a major crisis, right? We're talking about a dot-com bubble crisis. Could this be the AI bubble, right? There's a lot of speculation of an AI bubble that's about to pop. It just so happens that we're about to get rate cuts. So that's a possible theory, okay? We won't dive too much into the fundamentals of AI and whether or not, that's a possibility or something that's true currently at the moment, but it is something to consider, right? Are we perhaps on the verge of a great financial crisis, right? These are the questions you want to ask yourself. And if the answer is yes, then you want to act accordingly based on your own beliefs, right? If the answer is no to you, then you want to act accordingly, right? What's really interesting to me is that only in the dot-com bubble did technology, right, which is going to be the middle graph right here. Only in the dot-com bubble did we see technology actually go lower, okay? The past 2 rate cuts historically, we actually see technology continue to rise steadily, okay? So keep that in mind as well, because the market has changed so much over the past 20 years that the top stocks in the world, and more specifically in the S&P 500, they're all tech stocks, okay? And these tech stocks now hold a major weight in the stock market. And we've seen that the last two first rate cuts have led to higher prices in information technology. All right. And then down here, you've got the Fed funds rate, just so you can actually see what's going on here with the cycle. All right. Now, of the 14 rate cycles since 1929, 12 of them saw positive S&P 500 returns for the 12-month period following the first rate cut. That's also very, very interesting. Okay. So remember, everyone's trying to tell you that we're going to have a mega crash. The data does not necessarily support that, again, unless we're on the verge of a dot-com bubble type crisis or a great financial crisis. Because if you look, I remember we talked about 12 of them saw positive returns in the S&P 500 for the 12-month period, aka 1 year later after rate cuts, the market was positive 12 out of 14 times. That's 6 out of 7 times. That's a high odd, right? Those are high odds of success. 2001 and 2007 are the two instances where we did not have positive returns in the S&P 500 the following 12 months later. Again, what was that? That's the dot-com bubble era, and that is the great financial crisis era, okay? So it doesn't necessarily have to be, an event that leads to a 20% sell-off, a 30% sell-off, etc., okay? And when you look at the history of Fed rate cuts, the max drawdown, okay, so this is more specifically what we're looking at, okay, the forward 12 months returns and the drawdowns after a Fed cutting cycle start, so these just show you the overall returns 12 months out. Here, specifically, the magnitude of the drawdown is dependent on a recession versus a non-recession. So the average drawdown without a recession is -4%, okay? This means that on average, right, not that every single time we drop -4%, but on average, we have about a 4% correction within the 12 months after the first rate cut. That falls in line with your standard pullback in the market of about 5%, your standard, correction. Okay. So that'll be really interesting to me. If we don't have a recession and we only average about a -4% drawdown, that's not too scary for me. Okay. That seems like your average market volatility. We've seen the stock market drop 4% just in the first week of September alone this year. Okay. Now, the average drawdown with a recession is going to be about -16%. Okay. And so that's going to be far greater. And that's, again, the major thing that I really want to make emphasis on in this video is the rate cut cycle. What happens afterward is really more dependent of, can we actually get a soft landing and avoid a recession? Or are we in the middle of a recession, starting a recession, or about to be in a recession within the next 6 months, 6 to 12 months? If so, then that's when things get a lot more messy in the market. Now, no matter how much data you look at or forward-looking data, it's going to be hard to predict whether or not we're, going to experience a recession. But let's do the best that we can. So let's look at the yield curve. This is the inverted yield curve that we have currently. And so you see these gray areas here, these are recessions. Notice how these come after the yield curve is no longer inverted, right? Meaning that this blue line here is above this horizontal black line, okay? That is the level 0. And so what do you see? Yield curve becomes uninverted. We're back above 0, recession. Back above 0, recession. Back above 0, recession. Back above 0, recession. Here, we kind of went inverted. I wouldn't really count this too much. But again, recession afterwards. And here we are. Now, it's not an immediate thing. It doesn't mean that at the very exact moment that the yield curve is no longer inverted, that we're in the middle of a recession. But oftentimes you do see a recession follow afterwards. You've got the 10-year 3-month yield curve. All right. This is another one, another yield curve that a lot of people look at. And again, you see very similar results, right? Inverted, no longer inverted shortly after recession. Inverted, shortly after inverted, not inverted anymore, recession. Inverted, shortly after it's not inverted, again, a recession. So this is one of those things that could signal to us that, hey, maybe we actually get that cycle or that period where we do come into a recession during the, after the first Fed rate cut. And we went over the data, we usually see about a negative 14% drawdown on average. Now, here we've got the GDP-based recession indicator index. All right. Now, if the value of the index rises above 67%, that is a historically reliable indicator that the economy has entered a recession. Once this threshold has been passed, if it falls below 33%, that is a reliable indicator that the recession is over. So this is another thing that you guys can look at. Again, this is the GDP-based recession indicator index, right? So you got your red line here. That's basically, hey, we're heading into a recession. We're in a recession. The green line, hey, we're falling out of that recession. Take a look at where we're at right now. We are nowhere near the GDP-based recession indicator index recessionary levels. So if this thing really starts to tick up here, this is something you want to watch out for. Again, the yield curve, the 10-year, 2-year yield curve is signaling that we could potentially have a recession if that indicator is going to be correct again in the future. We just don't know exactly how long. All right, this right here is telling us we're not close to a recession at all. So if we monitor this over the next 3 months, 6 months, 12 months, and we see this thing start rising and rising rapidly to the upside, getting towards that 67% level, well, then that's going to be a major cause that perhaps we're in the middle of a recession or about to begin a recession very, very soon. You've also got the SOM rule. Okay, this is the real-time SOM rule recession indicator. And basically, once this rises by 0.5 percentage points or more, that's when we typically see a recession, and we're right there at those levels as well. I think we went to like 0.53. So this is another indicator here, economic indicator, again, perhaps suggesting that we're in a recession or about to go into a recession. Right now, Claudia Sohm herself said that this time may be different. Now, those are always dangerous words, but I do want people to realize that this time is always different. Every single time has always been different, and there's always different things going on in the economy. The dot-com bubble was much different than the Great Financial Crisis, which was much different than the Great Depression, okay? These indicators are just more of ways to help people gain an edge and give people, some insight potentially into the future. But there's always going to be different factors that could void out one of these recessionary indicators. Now, initial jobless claims are low relative to the average. Okay, so when we talk about the labor report, and that's a lot what the SOM recession indicator, focuses on, we're still low relative to the average, right? And so you've got the average here. When we zoom into this and we take a look, we have had an uptick here, but we're still 133,000 below the long-term average. So yes, we are starting to see this rise, but we are still relative or low relative to the average. So that kind of suggests that, hey, maybe we don't have to have this recession, right? Another thing that a lot of people always talk about is credit card debt. Okay, and people will, in my opinion, misinform you guys, and they'll post these charts saying credit card debt is at record all-time highs. Well, I mean, that only makes sense if we have inflation. I mean, if we know we have inflation. It's something that the Fed's been fighting for a long time, and it's something that's been around, for decades and decades, and it's been around, right? Inflation is not some new thing that just happened. So if you think about that with inflation, all the numbers should be going up constantly, right? Because there's inflation. So when you actually inflation adjust credit card debt, we are back near the levels of 2020, right? Pre-pandemic inflation adjusted, and we're nowhere near the levels right around the Great Financial Crisis, okay? When you look at inflation adjusted credit card debt. So while you could say this is breaking out, right? And, we hate to do technical analysis on, something like, inflation adjusted credit card debt, okay? It's not a stock. But when you take a look, yeah, you could say this is breaking out, but we're only up 1.8% from the start of 2020, okay? So it's not like credit card debt is spiraling out of control. And another thing you have to think about is the interest rates, right? So anybody not paying off their balance on their credit card debt, interest rates are so high right now that credit card debt is going to compound so fast, right? And much faster than people realize. Some people don't even realize that. it sounds crazy, but some people don't even realize that that debt is compounding. All right. It's doing the opposite effect of having your investments compound. You're having your debt compound. So even with compounding debt and much higher interest rates, we are still below the all-time highs in inflation adjusted credit card debt. And another thing I want to go over, right, is if you can stomach volatility, right? Even if we're going to have a recession, or even if we stick a soft landing, when you really take a look at things and you see that, once you have a holding period here of about 11 years, really 12 years, um, you have 100% of the time that the S&P 500 is positive, right? So if you're someone who's, looking to invest in a retirement account, or wondering whether or not you should just hold out from the market right now, but you still have 12 years before you are going to rely on those funds, or perhaps have to pull those out. The track record is amazing for the S&P 500, right? And so when you think about it that way, and you think, hey, well, I'm not going to see this money, I'm not going to use this money anyway, it's going to be locked away in a retirement account. Do I have 12 years, right? Do I mind? Hey, it may take 12 years potentially for, me to see some positive returns on this, but, do I want to just leave that money in cash? Remember, we talked about inflation, where that cash is going to lose its value, right? Yes, we have really high interest rates right now, and money, things like money market funds, et cetera, or even treasury bonds, are giving out some decent yields these days. But overall, that is not going to be permanent, right? It could be. We could see rates lock up here forever and remain to go unchanged, but the odds of that are very, very minimal, right? It's non-zero, but it's very low. So this is another thing that I want people to just keep in mind is, if you're truly long-term investing, right? And a lot of people think of long-term trades or things like this as 6 months to 1 year. um to me, that's really not long-term investing. Okay, that's just more of like a theme-based trade, or an idea that you have, versus putting money away that you're not touching for over a decade, right? So I just wanted to throw that in there. And I know things can get scary, people can get very fearful, but as you increase in time, the percentage of time that the S&P 500 is positive, is as the holding period gets much longer, you see that the odds really are just stacked in your favor. With the majority of the time, after 3 years, you're looking at 90% odds of the S&P 500 being positive, after a 3-year holding period. So shout out to Ray Holt's Wealth, and the compound. This was a really amazing chart right here. And then look at this. Okay, we've got the New York Stock Exchange advanced decline line making new all-time highs yet again. This is something we continue to see, over and over and over and over again. We're continuing to see new all-time highs in the number of stocks advancing versus declining. And this is, to me, this is pretty important. Okay, this is an important indicator. And what this really screams is market breadth. Okay, is we are seeing more stocks making new highs, more stocks advancing. We're not seeing stocks limited to just 5 stocks, to just 10 stocks. Gone are those days. And so, because we're seeing this is something that's kind of kept me from shorting the market so much. And rather than looking for, what are the most bearish setups, I'm looking for good opportunities, to long some different names that maybe most people traditionally wouldn't be looking at, right? Another thing that has me doing that is when you look at the equal weight versus market cap weighted S&P 500. So that's what this line is on the top. When you see this going up, it means that the equal weight is outperforming the market cap weighted. And you see we have this period here where we have this massive outperformance, and now we're consolidating sideways, potentially retesting this initial breakout trend line right here. So it'll be really interesting to see, do we continue to see the equal weight outperform, as we have Jerome Powell potentially about to do rate cuts next week, or are we going to start to see the market cap weighted go back to outperforming? That's something that I think will be pretty interesting and, potentially telling for the rest of the year, as we move forward and look at what could potentially happen. And again, when you look at the RSP, this is the equal weight S&P, we just made new all-time highs not that long ago, and we're very, very close, right? We're less than $1 away, from all-time highs once again in the RSP. So, that's pretty interesting to me. Now let's get into the juice of the video, which is going to be TLT. Okay. And so, as I mentioned, there's three things we're looking at here currently. All right. Number one, right, is going to be the initial trend line break, right? We rejected here, we rejected here, right? And we rejected here again. And we got a very strong and decisive breakout right there. That's number one. Okay, so trading above that, we're bullish on TLT. Number two was trading above the high anchored VWAP. Okay, from over here, when we put in the highs of 109.68, you slap an anchored VWAP to there, and the anchored VWAPs are really great tools because it tells you who's in control of the price action. If you're above an anchored VWAP, it lets you know that the bulls are in control, and if you're below an anchored VWAP, it lets you know that the bears are in control. And you see here we had a false breakout, right? False breakout above the anchored VWAP, false breakout above the anchored VWAP, false breakout above the anchored VWAP. And right here at this moment is when we actually came up, retested that anchored VWAP as support, and we got a very strong push higher. Okay. We have an anchored VWAP to the lows here as well. You can see, we're trading nicely above that also. But the other thing, all right, and number three is going to be the 61.8% Fibonacci level at 99.27. It's a very important level, all right. And once you're trading above a 61.8% Fibonacci level, the odds greatly increase of a full 100% retracement that will take us up here closer towards 110, right, to the 108 to 110 area. Now, as far as the Elliott wave analysis goes, I've been mentioning that we're in the middle of a larger wave 3 right here. Okay. The market tends to move in 3-wave or 5-wave structures. Okay. You have, 3-wave corrections and you have 5-wave impulsive moves. Right. So, if we move my head out the way a little bit here so you can see wave 5. All right. This is our larger cycle that we're currently in. Wave 1 up, 2 down, and then 3 up, 4 down, 5. Okay, this is the larger cycle right here. Okay, within that, every wave 3 is typically your most impulsive move, right? And those impulsive moves come in 5-wave structures, and that's what we're currently looking at here. Okay, so from 2 to 3, we should see a 5-wave move. That would look like this: 1, 2, 3, 4, 5. Okay, that is our 5-wave move to take TLT again up to that 109 to about 110 area. And when we look at our previous chart and we see that we're trading above that 61.8% Fibonacci, and we know that typically the odds increase of a full 100% retracement, where does that put you around? Right around 110. Now, within this larger wave 3 that we're in, okay, so wave 3 right here, we are actually currently in wave 3 of 3. Okay, so now we have 1, 2, 3, 4, 5. Okay, so these 5 waves are going to be the 5 that take us up here, roughly to that 110 zone. All right. And currently, it's been following the analysis perfectly. Okay. We came up, we retraced right here to the 61.8. We bounced exactly off of there, the support level. We came up, hit wave 3 targets, got the wave 4 pullback down. And now we're in wave 5 of this 3 right now. And these wave 5 targets, okay, and this is basically for the Fed rate cut cycle. These are my price targets, right around 101.96. 103.46 and 105.49. This is where I think TLT can get to if the Fed cuts rates. It largely depends on how big of a rate cut they do, whether it's 25 or 50 basis points. A lot of people are saying after the recent CPI and PPI that the odds have decreased. So we're most likely going to get only a 25 basis point rate hike, or I'm sorry, rate cut. But I think that will push TLT somewhere roughly in between this 102 to about 105 area, at which point, that would be our wave 3 targets. And we would expect one more pullback for a wave 4 and then a wave 5, up here to that 109 to around 111 area to complete wave 3. All right. So that's what I'm paying attention to. Okay. And that will take us into next year. Just this wave 3 right here, this larger wave 3. And then next year, most likely we'll start a wave 4 pullback and then get, a continuation potentially to the upside if the Fed continues a cutting cycle, up potentially, I think, right around to 115 to about 118 on TLT next year. So that's my thoughts on TLT. Now, as we mentioned, there's always going to be risks. Okay, so we have to go over these risks and we have to be mindful of them. We have to know what they are so we can manage our risk accordingly. Okay, what we've got here are a series of gaps down. All right, we've got a gap down to 85, 86 area. Got a gap down to the 91 area. We've got a gap down to the 94 area. And we've got a gap down to about the 95.5 area. Now, most likely for these gaps to fill, it would take some type of external event. Okay. Meaning, hey, the Fed is signaling that they're not going to cut rates at all. Maybe maybe inflation really starts kicking back up, or maybe something happens overseas. Who knows what the case would be? But there would have to be a pretty big shift for us to come all the way back down, and for Treasury yields to rise to the yields that they were at. As you know, yields going up results in bond prices going down. So yields would have to rise dramatically for TLT to come down and fill this $85 gap. Now, some of these shorter and closer gaps, smaller gaps, TLT moves pretty wild, guys. It moves pretty fast, and a lot of these gaps on these charts have filled, right? There was gaps over here, they filled, right? We have gaps over here that got filled, right? The gap in this area. We had a gap in this area that got filled. So a lot of these gaps do get filled, and this is something that you want to keep in mind, as a potential risk factor moving forward, trying to invest in something like TLT is that, if something changes in the economy or the Fed policy, this thing can reverse, and there's some areas that will act like magnets if we start to see some significant downside in TLT. Now, that'll wrap up today's video. Don't forget, you guys can join the Investment Intelligence private trading group using code Powell. That gets you full access to all of the tools and resources in there inside of the Discord, and for the investment intelligence community. So that'll be things like the zone finder, the pulse radar. Basically you're going to get over 20 plus swing trade ideas every week. You get access to my custom scripts and indicators, scans, exclusive intel, exclusive chart layouts. All right. You also included in there get the pulse radar. Now these are available for separate purchase if you guys want just the pulse radar. Again, these are a shorter term swing trade list from anything from 1 to 3 days to even a couple weeks, from 1 to 3 days for some people who are very short term, or for some people, you can hold these for 2 weeks up to 6 weeks, right? That's what the pulse radar is designed for. All right, again, in less than 1 month, we're seeing call options go up thousands of percent on some of the trades from the pulse radar longs. We've got the zone finder. Okay, this is an intraday to swing trade list. So, these stocks, they have setups that are actionable that day, right? And that you could potentially see profits on that day. And if you do want to swing trade them, you can swing trade them 1 day, 2 day, potentially up to 5 days. For the zone finder is really what that one is meant for. So both of them are meant to be actionable. You can get both of those separately, or you can join and get the full access to the Investment Intelligence Discord. And in that, you'll get the zone finder, the pulse radar, and everything else. Okay. Don't forget about the newsletter, all right, where we put out trade ideas, free content, lots of valuable stuff. As we mentioned, the very first trade idea from the zone finder was in there. This is what the zone finder looks like. It gives you a demand zone, a risk on entry zone, gives you price targets, supply zones to the upside. Most recently, just yesterday, we put one out on Best Buy, all right, BBY. You can see in 1 day, in a 1 day swing trade, those call options went up over 100%. Really nice move right there. Check out the newsletter, all right, check out the website, sign up for that using the link in the description. You can review it, see if, those articles are something that you want to get sent directly to your email inbox. If so, you can sign up for that. And I also do coaching sessions or one-on-one Zoom sessions. If you guys ever want to book one of those, all you have to do is simply click on my Ko-Fi page. There's a link in the description for that as well. Click on the commissions tab, and then you can click on the buy a coffee button if you want to leave a tip or donation, or you can directly book a 30-minute or a 1-hour session. using that commissions tab right over here. And that will get you, you can book that 30 minutes or 1 hour session. And that's for people who have a lot of questions, right? And people who want to go over day trading dynamics, because I do a lot of day trading. I do futures trading. When it comes to day trading, I do options. We can go over swing trading strategies. You can have an interactive Q&A. However you guys want, I'm here to help you guys. That's the whole purpose of the one-on-one sessions. So thanks again for watching. Smash the like button, subscribe to the channel. Help me get to 10K subscribers. Getting close, okay? We're about 1,000 away, less than 1,000 away. So all you got to do is subscribe, share the videos with your friends, okay? And help me get to 10K. That'll be really sweet if we can get to 10K by the end of the year.